Hello, everyone, and welcome to this month's 7 Investing podcast. My name is Simon Erickson. I'm very excited because we are welcoming a new lead advisor to 7 Investing. His name is Dan Kline, and I'd like to introduce him to all of you in the first part of this month's podcast. Dan, first of all, welcome to 7 Investing.
I am excited to be here. It has been a very long wait.
We are very excited to have you, too. Could you start off by telling us a little bit about your background?
Sure. I was born in no, just kidding. So I'm a journalist by trade. I started as a college newspaper editor. I worked part-time at a trade magazine covering the audio industry. My boss got fired over Christmas, where I'm still not sure why. I ended up becoming the editor of that magazine. So my senior year of college, I worked full-time at a magazine. I had to travel for work, and like explaining this to my teachers was not easy in a pre-cell phone day. It's like, yeah, I'm not going to be in class. I'm in Vegas that week for a trade show. Like, that was a little tricky. I was an early internet pioneer. I was the editorial director of a site called uproar.com, which IPO'd back at a time where you could IPO with no revenue. I then worked for a men's lifestyle startup that got bought by Playboy, and then have had a really weird career since then. I ran a giant toy store. I spent 4 years working in my family's ladder and scaffolding business. And I actually think that's how I got into writing about business, because I kept interviewing for jobs, and I would say, when are you going to find a business guy who's actually bought commodities? Like, I've bought steel. Like, I understand how all this works. So finally, a friend of mine calls and he says, "You want to work for Microsoft?" And I said, "Sure." So the guy from Microsoft calls me up and he interviews me a little, and he says, "Do you want the job?" And I said, "What is the job?" He said, "I can't tell you what the job is. Do you want the job?" And I said, "I guess I want the job." So I was the launch editor for the MSN Money app. It wasn't called that. It was the Windows 8 Finance app at the time. But I was the guy that picked what stories went in the app. And that's now done incredibly terribly by a robot. There's no more people involved. But there used to be people, and I was the person at first. And I stayed there for a little over a year. And then I went to the Boston Globe. That was my childhood dream. I grew up reading the Globe, and I was running the business desk for Boston.com. And what I didn't know about the Boston Globe, which is a lovely place, is that there's a divide between digital people and print people. But I wasn't clued into that, so I was blissfully unaware. And most of the .com editors on the Boston.com side didn't sit with the print people, but I did. I actually sat with the business team, who all hated me, and nobody spoke to me for like 4 months, except for the business editor, who was the acting business editor at the time. The regular one was out on maternity leave, and he liked me, and we got along. So I pushed and pushed and pushed, and he finally let me write a story for the paper, thinking it was just going to be a big caption for a photo. And I wrote a story on PAX East, which is a video game and gaming convention. It's a lot of people come in costumes. It's a pretty cool thing. And I handed it to the editor I was working with, and he read it. And I had sent in like a 1 o'clock draft so they could get an early one up. And he texts me back or emails me back, and he says, "Oh, wait, you can do this. You can write." I'm like, "Yes, I have 20 years of journalism experience. The fact that I didn't come from the Pittsburgh Post-Gazette or whatever doesn't mean I can't do this." He's like, "Oh, okay, let's work in the story. Let's get it in front page contention." So my first story did not end up on the front page, but was pitched for the front page that day, led the business section. So I became a regular writer. The problem is, my first day at the Boston Globe, which is really my introduction to the market and to covering business, but other than being a curator at Microsoft, my first day there was the day the New York Times Company put us up for sale. So we didn't move. I still lived in Connecticut, about 2.5 hours away. I was commuting and staying at my mom's in Salem, Masslot. It was really difficult. So I ended up going back to work for a small company in Connecticut that owned 2 daily newspapers. I was the editor of 2 daily newspapers. And on the side, I started writing for Motley Fool, for a now defunct product called The Business. And the idea was to do things a little bit broader than just stock market coverage. And I worked there from like 3 a.m. to 5 a.m. for like 2 or 3 months before I finally went to my boss and quit my job with, by the way, at the time I was getting paid $50 a story. So this wasn't a smart decision I made. I quit my job. I went to work with a business partner. He was building websites. We just kind of sat in a room together and worked all day, and eventually ended up buying some websites and doing some other things that made me some money. But at this time, I started getting indoctrinated. I started learning this is how the market works. I started out as a journalist, as a news reporter who was adding a little bit of analysis. And then over 6 years, I actually woke up a few months ago and realized, oh my God, I'm a world-class analyst. Like I can compete with all of these people who that's how they define themselves, because I found myself hosting live shows with, some of the biggest names. and going, oh, wait a minute, like my opinion is not only as valid, sometimes it's more valid. And the example I'll give, and I hate to talk about this one, but Luckin Coffee. Nobody can predict fraud, but I always predicted Luckin was going to be a failure. Why? Because their business model was giving away coffee to get the Chinese to like coffee. Here's the problem. The premium brand is Starbucks. They were giving away a product to get people interested in what their competitor did. It wasn't going to help their brand. It was a bad strategy. It was never going to work. It's the old, I'm giving away, $20 bills for $19 and I'm making it up on volume. It wasn't going to work. So I gained a lot of confidence. And from the point you and I started talking right at the beginning of the company was really when I started thinking, wow, like this is what I want to do. Like I want to help people, do better with their money.
Dan, one of the things I'm so excited about working with you here with Seven Investing is that you have not only had your pulse on what's going on in the business world out there from the journalism perspective, but you've also run the operations of so many different types of companies, such a diverse background. It's fascinating. I'm really excited to see your perspective on so many things. As a lead advisor for Seven Investing, you're going to be making recommendations every month. I wanted to ask you in my next question, how would you describe your investing style and what types of companies do you tend to look for?
So I'm a singles hitter who occasionally shocks you with a home run. So I follow areas that people aren't that interested in. I follow retail. And look, I could have told you not to invest in a lot of retailers in the last few years, but it's tricky to tell you which ones were good. Is it sexy to say go buy Costco or Walmart or Target? No, it's not. But those are all good companies you should probably own because you don't have to worry when you own those. And I'm not saying those aren't going to be 10 baggers, but those are good, like nice things to just like you got a little extra money, have a little bit of that. It'll go up steadily. I often call them elephant up a hill stocks. Like it's going to get there. It's not going to be that exciting. But then occasionally I find some, it could be retail, it could be a cannabis stock, it could be a little tech stock. Like I cover a little bit of everything. I'm a voracious planner and reader, which you'll see as we start our live streams. And sometimes I'll find something and I'll just spend like 6 months looking at it. I'll watch the earnings calls. I'll interview the CEO. Like I'll do, and I'll pick some company that like when I bring it up at the meeting, you all have to like look it up. And maybe that'll be my pick. So, if I make 12 picks this year, 9 of them are going to be companies you've heard of, but when you hear my case for it, you're going to feel a lot better about it than maybe you did. The other 3 might be companies that you're like, wow, that's exciting. And if one of those 3's hit, and one will, you will do really, really well.
And you mentioned retail, but I know you also have a lot of experience in investing in media and entertainment companies as well, right? And telecom companies.
Yeah, media entertainment. I'm probably the leading expert on cord cutting. Not that that's a thing to be that proud of, but like nobody's followed it on the level I have. And the shift we're going through with, look, everyone wants like the latest 5G stock, and they want you to name some like tech company they've never heard of that makes like a widget that's going to sell. That's not how it works. It's really understanding what the adoption cycle is going to be. What are T-Mobile, Verizon, and AT&T actually doing? They're all running commercials saying they have 5G. You know what they don't have? They don't have 5G. That is a real problem. And what's Comcast or Charter's business going to look like, and how does that fit into what I invest in? You might not invest in Comcast or Charter, but you need to know what they're doing and what their sort of competitive advantage is as internet service providers that informs how you might pick other companies. So yeah, I've often been called a jack of all trades. My negative about that is that phrase goes jack of all trades, master of none. I am a jack of all trades, but I'm a master of a handful. I have spent the last 7 years studying. Half of my day is just reading. I get up at 7 a.m. every day for the last 7 months of the pandemic, and I prepare a document of this is what's going on in the world to inform shows I'm going to do. That's work I like doing. I've always been a reader, though when it comes to reading books now, I read absolute garbage because my whole day is spent in white papers and news stories and who knows what. But I am really excited to sort of change people's minds on how they look at certain types of investing and types of companies.
Absolutely. Dan, we are so excited to have you on the team. For everyone listening to this, Dan is a very high impact guy. He's an advocate of the individual investors. He shares the same mission that we do of helping you invest in the stock market and make sense of this thing and get more actively involved in the money that you're saving out there. Dan, how should people get in touch with you? We know that you're going to be doing some live stream events with Seven Investing, but is there other ways that people can reach out to you also?
Sure. So I haven't changed. I am going to change my Twitter handle, but I haven't changed it because I get to promote it in the former place I worked, and it's beneficial to everybody for it not to change. So right now, my Twitter handle is @worstideas. That is a play on my book, Worst Ideas Ever, which is sort of a business book. It's like New Coke and the XFL, the original one, not the new one. Some of the things, it's kind of a funny scholarly treatise. It's a really good book. They don't send me any more money when you buy it. They should, but they don't. So, buy it if you like, but you don't have to. So you can follow me there. I am easy to find on Facebook. It's facebook.com/Dan Kline. But probably the easiest thing to do, just shoot me an email. I am D Kline, DKLINE @7. That is the number 7, or you can write it out, investing.com. That email is up and running.
Absolutely. And like you said, worst ideas. There's a lot of changes underway in the media industry and the retail industry and the entertainment industry. I'm really looking forward to seeing some of your recommendations, Dan, and welcome to the 7 Investing team.
Thanks for having me. I'm excited to get started.
With that said, we'll now join the rest of this month's 7 Investing Team podcast. Hello, everyone, and welcome to our 7 Investing Team podcast. Here at 7 Investing, our mission is to empower you to invest in your future. We do that by providing our best stock market opportunities for just $17 per month, but also educational content such as this podcast. My name is Simon Erickson. I'm a lead advisor here at 7 Investing. I'm joined by my other lead advisors, Matt Cochran, Steve Symington, Austin Lieberman, and Max Chatsgo. Gentlemen, welcome to the podcast. Thanks for being here.
Excellent. Can't wait to get started.
Today's topic is going to be about international investing, because investors kind of have a home court bias where we like to invest in the companies that are in our own country, that we're most familiar with. Perhaps we're already consumers of their products. But truly, innovation is taking place all around the world, so it always helps as an investor to keep in mind those global opportunities. And so we're each going to be introducing a company that is on our investing radar that is not domiciled in the United States today. And before we get started, just a reminder, these are not official recommendations. These are simply ideas that have our interest and might be worth more due diligence in the future. So Matt Cochran, I'm going to start with you. What is one international opportunity that's on your radar right now?
Yeah, thanks, Simon. And it's so important to note that there are opportunities all around the world, and there's no need to just limit your scope to the country you live in. One company that's caught my eye, and I actually took a small position in earlier this year, was Singapore-based C. It's quickly becoming a digital powerhouse. It has 3 very fast-growing segments that are poised to capture more upside in some of today's largest industries, and that includes video games, mobile commerce, and digital payments. And so, just real quickly, Garena, that is C's global game developer and publisher. It has a significant presence in Southeast Asia and Latin America. In 2019, its game Free Fire was the most downloaded mobile game in the world across Google Play and iOS, according to App Annie. In its latest quarter, C's digital entertainment revenue grew 62% year over year. Shopee is C's e-commerce platform, and that connects buyers and sellers, supported by payments, logistics, fulfillment, and other value-added services. If you think Shopify, you're kind of in the right ballpark there. Revenue in this segment in its latest quarter jumped 188% year over year. And then finally, C Money. That's C's e-wallet services. It offers just a bunch of financial products and services, mobile wallets, payment processing, credit-related digital financial offerings. It's branded, depending on the market it's in, it's branded differently. Sometimes in some markets it's known as AirPay, in some markets it's known as Shopee Pay, in some markets it's known as Shopee Pay Later, and it has a bunch of other brands, but it's all encompassed under C Money. And while it's still the smallest of C's business segments by a large margin, as far as revenue contributed to the company goes, it's still in its latest quarter saw more than $1.6 billion in total payment volume, and it had more than 15 million quarterly active users in C's most recent quarter. So that's the company that caught my eye. It has exploded this year. I took a small started a position earlier this year before pre-COVID, and I bought it between $40 and $50. I was hoping to add to it, and it kind of got away to me. It's kind of tripled unbelievably this year, but that's just because it's in all the right markets, in a post-COVID world. As mobile technology is taking off, especially in emerging markets where access to hardline internet is not necessarily popular or widespread. And so it's in all the right places for emerging markets. And that's why it's even starting to compete with Mercado Libre on its home court in South America. It's growing in a lot of different markets around the world. And so it's a company that's really caught my eye.
Yeah, absolutely, Matt. You said they're based in Singapore, but is its markets really mostly Southeast Asia? And is one of the reasons that it's doing so well, that it's different than the United States, is because they've kind of leapfrogged this desktop, fiber in the ground and gone strictly to mobile? Is that an opportunity for them?
Oh yeah, absolutely. And it's in it's all across Southeast Asia. It's in Thailand. It's in Vietnam. I know those are large markets. Most Southeastern Asian countries, it has a significant presence. And like I said, it's even going into Latin America. Its game Free Fire is extremely popular in Latin America. And one of the reasons why is it's Free Fire. It's almost like it wouldn't necessarily be a popular game in the US because its graphics standards are a little bit less. It's not meant for like a 4G LTE connection, but it's great for like a 3G or lower tier 4G connection. But it's just like one of those first person shooter games, shoot 'em ups like Fortnite and other popular games, and it's just exploded in popularity.
Perfect. And the ticker on that, Matt, I believe is SE, correct?
That is correct, and it's listed on the NASDAQ, so it has an ADR in the US.
Great. Thanks very much, Matt. C Limited. Let's go on to the other side of the world here. Max Chatsgo, let's go with you next. Your idea on your radar is a European energy company. Tell us a little bit more about this one.
Yeah, so I use this company called Equinor. I don't own it. I don't plan on buying it anytime soon, but I kind of use it as a gauge to see how oil and gas majors are thinking about the energy transition. So Equinor a few years ago was actually called Statoil, and it changed its name to remove the word oil from its name. And it also made this pivot in a way to kind of refocus investors on the long term. So it's taking it's a Norwegian company, so it has a lot of experience in the North Sea, pretty choppy, volatile off-sea drilling area. So it's taking its experience there in offshore oil rigs and gas rigs, and using that to become a first mover in offshore wind power assets. So it's kind of an interesting transition, if you will, and especially because the offshore wind industry globally isn't very large. So it's still kind of it's expensive. There's still a lot of questions about, is it going to become a thing? But on paper, it makes a lot of sense, right? You have a lot of major population centers or along coastlines, and offshore wind is intriguing because it can be very, you can build huge wind towers. I mean, some of those are like taller than the, Statue of Liberty, or, I mean, they're just massive. And, they provide power more consistently than onshore wind. So that's exactly what you would need for, a large city. So Equinor bought some acreage off of, around the world, in Europe, in the United States, and China, throughout recent years. And in the United States, that's kind of interesting because there's virtually no offshore wind industry here at all. We have one offshore wind farm. It's very small. I think it's off the coast of Maine. It's up in New England, and it's like nothing. It's pretty old technology. So Equinor started going around and saying, hey, we're going to buy some acreage off the coast of Massachusetts, some off the coast of New York. And this was when the Department of Energy started to really open up acreage for auctions. So the company bought a few different positions in offshore. So like it owns the Empire Wind project off the coast of New York City, also owns Beacon Wind off of the coast of Nantucket. And it bought these, acreage plots for about $180 million total. And then just recently turned around, I think this month actually, and sold half of the equity stake to BP, fellow oil and gas major, for over $1 billion. And the two agreed to, develop the U.S. market. And so it's a kind of an interesting, partnership there, right? The pipeline for the U.S. is in total offshore wind projects is like around, it's almost 30,000 megawatts. So from 0 to 30,000, that's pretty impressive. And a lot of these might come online this before the end of this decade. And there's like another like pipelines a little bit further off maybe, but up to 2035. So this is something that could really come out of nowhere, be a huge opportunity, provide a lot of energy, a lot of electricity that's, renewable, clean, and help some of these major population centers wean themselves off of, dirtier sources of fuel. So it's important to note though, that this is a very small part of these overall businesses right now in Equinor. It still predominantly generates most of its money from oil and gas production, but you're starting to see other companies, you have Oil Dutch Shell, BP taking stakes in renewable power asset developers, and you have Total, the French major, is investing in this very big investor in energy storage, for instance, lithium-ion batteries. So it's kind of interesting to see where these are going to go as the world starts to transition away from liquid fuels.
Yeah, it's really interesting, Max, that it seems like wind, just like oil, is a kind of a geographic presence, right? There are certain places that are getting the best wind or the most interesting that companies are wanting to place those on. Is this an advantage for Equinor in the long term if they're going out and buying the most attractive spots before everyone else is?
Yeah, I think early on, probably, because it gobbled up all this acreage when it was still like a big question mark. Is this market going to develop? So yeah, I think so.
Yeah, great. Okay, and the ticker on that, I believe, EQNR, correct? Previously Statoil, now Equinor, based up there in Norway. Great one, Max. Let's go over to China for the next one. Austin Lieberman, your company is a Chinese-based tech company.
Simon, what if I told you that you could invest in a company with 128% revenue growth? They had $98 million in revenue their last quarter. They grew active customers by 85%, gross margin of 66%, a dollar-based net expansion rate, meaning customers are spending this much more each year, of 183% over the trailing 12-month period, and they're profitable on a non-adjusted basis with $3 million in net income in the last quarter. What if I told you you could invest in that company? What would you say?
I would say that is amazing, and I would demand you tell me the name of this company.
So I will tell you the name of the company. This company is called Agora. Ticker symbol is API, and they've got actually a really unique structure. They've got dual headquarters in China and Silicon Valley, but it's listed as an ADS in the United States. So technically, they are a Chinese headquartered company. And I talked it up a lot at the beginning, right? Those are fantastic numbers. But as we've seen from some companies that aren't necessarily, they don't have to follow all of the SEC regulations if they're not listed inside the US, there are risks that can come with companies that aren't as highly scrutinized by the SEC. And so as great as all of those numbers are, even me personally right now, if that was a US listed company or a company that I was more comfortable with, I'd probably want to invest right now. But I'm still in kind of a learning mode to just try to learn more about this company. But those numbers are fantastic. And so what Agora does is they offer real-time video calling, voice calling, live audio, and video streaming, as well as real-time messaging. And they serve all the biggest industries. So social media, gaming, retail, education, even telehealth. And basically they just allow developers on different teams to build these real-time video messaging capabilities into whatever platforms they're using. So if you've heard of a company called Twilio in the United States, they do a lot of API stuff where you can basically build messaging and even video from app to app, or build real-time video integrations. They do something similar to that, specifically with video. And then if you think about it, a big use case for this is one of the more popular use cases is for retail streaming. So brands have utilized the technology to stream like live product demonstrations, and then you could have interactive features like text and video chat, so that if you're trying to sell something over social media or whatever, your audience can interact with you. It was founded by Bin Zhao, I think is how you say it, and it was actually founded in Silicon Valley in 2013. Prior to founding Agora, and this is interesting, is his background. He served as the director of a NASDAQ-listed company called YY, and most notably, he was a senior engineer at WebEx from 1997 to 2004, the same time that Eric Yuan was there, from the founder of Zoom. Again, their main executive offices are in China. That's where most of its revenue comes from. More than 38% of its revenue comes from its top 10 customers, which are all in China. And so there's a lot of international opportunity there, but also some international risk, because I also, as a consumer, I don't know the trends that are going on in China or other countries like I'm familiar with them in the United States.
Yeah, fantastic, Austin. One thing that I noticed about Agora is it's a usage-based model for revenue. And this is something you and I talked about a little bit before. How important is that to, kind of this machine-to-machine age that we're living in right now? Is that a huge advantage for investors?
Yeah, I think so. And so the kind of model for SaaS, and we've heard people talk about this, right? Even as late as Jeff Richards, we just had him on the podcast. He's a venture capitalist. There's usage-based and then per seat model. A great thing about usage-based is, even as we're entering a world where maybe companies are lowering their headcount a little bit, still, if more data or more video or more apps are used, that usage can still go up, even though seats are going down. And so that's the benefit of a usage-based model. It can work the other way though. So just investors be aware of that. Sometimes usage-based isn't the absolute best either. So there's pros and cons.
Yep. Great pick, Austin. And just for anyone that's unfamiliar with the acronym, Austin had mentioned ADS in there, which stands for American Depository Shares. You also probably hear ADRs a lot, which is American Depositary Receipts. Both of these mean that there's a sponsor bank within the United States, which means you don't have to go to a foreign exchange to buy any of these companies that we're talking about today. You can buy them directly on American exchanges. Don't have to worry about the exchange rates. Don't have to worry about international currencies or any of that stuff. It makes it a lot easier when you're dealing with companies that have done the work to get their shares listed on American exchanges. Steve, let's keep the trend going in China here. You also have a China company, a Chinese e-commerce leader.
I do. JD.com might be a name that some of you are familiar with if you're interested in investing in China, but it's been on my radar for a couple different reasons lately. First, I actually opened my first position after following the company for years back in March. It turned out to be good timing. Shares have roughly doubled since then. But I still think it has massive upside from here and could accelerate its growth quite a bit over the next few years. Right now, we're already talking about a pretty big business. Its market cap is, I think, 119 billion as of right now. And I mean, that's big in its own right, but it's still also dwarfed by Amazon, that's sitting, I think, 1.54 trillion is its market cap right now. And it's also similar as Amazon here in the United States, in that JD.com has made the decision really early to invest heavily in its own logistics, warehousing, and delivery infrastructure networks throughout China, rather than basically serving as a platform as, say, eBay has done, and kind of like Alibaba in that sense. But JD's basically worked to differentiate itself from competitors through these heavy investments in its logistics, warehousing, and delivery infrastructure. And that basically has come at the cost of profitability in these early stages, but over the long term, I think we'll see similar fruits as Amazon has enjoyed in growing its enterprise value. And it's really still doing very well. Revenue last quarter was up, I think, 34% year over year to 28.5 billion. And its operating income more than doubled to 714 million. And I think its mobile user base increased by 40% year over year. We saw annual active customer counts up almost 30% to 417 million people. That's bigger than the population of the entire United States, which is just stunning, really. And, it's also working to kind of unlock the value of some of its subsidiary businesses through a series of IPOs. So that should be something to watch. Reportedly working to have IPOs for JD Logistics. It's fine. That's its supply chain business. Its finance arm, JD Digits. Its online healthcare unit, JD Health. So lots of different pieces that it's kind of working to unlock shareholder value by potentially kind of breaking them out into their own IPOs. But it's also another thing to, I guess, keep in mind is that, you're talking about China, population 1.4 billion people. They have a fast growing middle class with growing income. And in China, just over a third of their overall retail sales currently comes from e-commerce channels today. And that's, according to Statista anyway, up from about 12% just 6 years ago. And they also expect that Chinese e-commerce should more than double its share as a percentage of overall retail sales to 64% of China's total. That really bodes well for any leader in the space, especially JD, given its differentiation with those higher investments in logistics and delivery. And it's really putting its money where its mouth is. Lately, I think only recently, it spent around $440 million to acquire, I think it's called Kuayu Express. Forgive me if I mispronounced that. It raised almost $4 billion through a secondary Hong Kong listing recently. And they say they'll use those proceeds to primarily invest in key supply chain technology initiatives and improve operating efficiency. So as we see kind of the fruits of that scale, it should really be really impressive for shareholders. And finally, before I wrap it up, we got to talk about cloud computing efforts. After all, Amazon's AWS served as a lucrative source of incremental high margin revenue. JD's services segment, they don't even break out their cloud revenue yet because it's still so small, but these are still early days. We've seen a number of interesting partnerships lately to expand that reach. And I think it's going to be a much bigger business, 5-10 years down the road than it is today.
Yeah, and Steve, I know you are a huge fan of robotics and follow that very, very closely. Tell me a little bit more about JD's logistics network. I mean, that's something they've put billions of dollars into the last couple of years. Is that a huge competitive advantage against other e-commerce companies?
I think it's massive, and it's something that a lot of other businesses in China just don't have and aren't spending a lot of money on, and there are, I guess, some of the big leaders, there's a potential that some of these really well-funded competitors will work to build out their own logistics networks, but it's something that JD's known for, and it's pouring billions and billions and billions into this. So with automated warehouses and contactless delivery options, and these are things that they have really worked really well on and really, really focused on, especially during the pandemic, to maintain their momentum while any other competitors might stumble. And I think those investments, especially in like AI, robotics, those sorts of things, these high-tech ways to expand their logistics network will pay dividends. Maybe not literally, but in terms of expanding its enterprise value.
Yeah, absolutely. JD.com. That's a great one, Steve. And we'll wrap this all up with my company is an Indian bank called HDFC Bank. Ticker on that is HDB. And what really attracts me about this is that India is got such a fast growing middle class, right? This is a country that as a whole could be expanding its GDP by 7 to 8% per year for the next decade, just as there's more purchasing power for people to be buying things. But the government of India itself also knows that with all of this fast growing middle class, it's going to have a lot of responsibilities as well. It's going to have to provide power for those people. So it's building solar farms around the country. It's going to have healthcare insurance for those people. So it's got kind of a healthcare scheme for the lowest earning half of its population right now. And so India, to do this, is cracking down on paper currencies because there was a lot of fraudulent business activity taking place that people just weren't paying taxes for. And it needed that tax revenue to fund those larger initiatives. And so a couple of years ago, about 5 years ago now, India invalidated its 500 and 1,000 rupee notes, the paper currencies, said, hey, if you want to keep those paper currencies, you've got to change them, exchange them with the banks. And so a lot of people did that. They kept currencies, but it also subtly nudged a lot of its population to do digital banking, where they weren't exchanging anymore with cash currencies, but actually using their cell phones for digital transactions and digital banking. And this is where HDFC really comes in, because HDFC now is using cell phones for more than 90% of the transactions that are taking place. This isn't people going into the bank like we got used to when we were growing up, or using ATMs to get money out, but it's just completely over a cell phone. And that really gets its cost structure extremely low. HDFC is the country's largest bank, so it's got more and more deposits that it's bringing from India's 1.3 billion people at a very low cost to serve those operations. And of course, when the country is growing at 7 or 8% GDP, there's plenty of loans to be making out there for other businesses that want to start building out their operations too. And so HDFC is just a company that I think is going to be a compounder for several decades. It's in a huge amount of tailwinds from everything taking place in India. And it's one that I definitely have my eyes on internationally.
And Simon, it's interesting to note too about HDFC Bank. I mean, it is growing really fast. Its earnings from 2015 to 2019 grew 4.5 times its earnings per share. I mean, that's incredible for a bank. You'll never see that in the US.
Yeah, it's one of those inflection points, right? Not just growing linearly.
Yeah.
Simon, I'm not super smart on the banking industry, especially not internationally. How reliant are they on interest rates, and what is that dynamic like in India? And are there any differences versus in India compared to US banks?
It is. It's much higher over there right now. And a lot of people are used to getting just interest rates from more conservative investments. Rather than putting your money in the stock market, you can get a much higher interest rate, or at least for most of the population, just parking that in a bank, in a CD or something that's a lower cost, lower risk investment. And exchange rates kind of also are an interesting dynamic between the United States and India too. A lot of Indian investors that are starting to learn about investing are investing internationally because the exchange rate is favorable for them too. But to answer your question directly, Austin, I think that it's a benefit to HDFC that the population of India likes more conservative investments, like putting your money in a bank and then letting HDFC use that for its own loan book. And so there's our international opportunities that our teams come up with this month. Again, to recap them, Matt said C Limited, ticker SE, a Singapore-based game maker, e-commerce provider, and also finance company. Max went with Equinor, EQNR, which is based in Norway, an energy company looking more at offshore wind. Austin went with Agora, ticker API, which is enabling video calling and streaming for a lot of apps that are out there in China. Steve went with JD, which is the ticker JD, also in China, one of their e-commerce leaders that's building out a logistical network. And I went with the Indian bank HDFC Bank, which ticker is HDB. So I hope that everyone enjoyed this month's 7 Investing Team podcast. Once again, our mission is to empower you to invest in your future. We are 7 Investing. Thanks for tuning in.